Most investors focus on their stock price going up.
We focus on earnings going up. The reason sounds complicated, but it's simpler than you think.
The mission is to shine the light into the darkness.
So, Bull, why are we so focused on earnings?
Well, like you said, Bear, the reason is pretty simple. Earnings are what make the stock price go up. Over the long term, as these companies earn more money, their stock price goes up. So with that in mind, our focus isn't really on buying the companies whose stock price will go up, because that's mostly a guess. If you're guessing which way the stock price is going to go tomorrow, you're guessing. But if you're buying companies whose earnings are going up, you're taking the guessing out of the equation, because this is known public information. You can buy companies who are profitable, like we talked about in our last episode, and who are growing their revenue and increasing the amount of money they're earning. And a lot of these companies who are doing this quickly happen to be technology companies.
All that's cool, Bull, but what's the framework for following a strategy?
That's a great question. So a lot of people just think of stocks as lines on charts. But when you buy a stock, you're buying ownership of a company that is earning real money. So, for example, we own 1.4 shares of Microsoft. That equates to a very, very small percent, 0.00002% of the company. That company, Microsoft, earns about $100 billion per year, right? So, of all the shares in the company, the amount of that $100 billion that's attributable to our very small 0.002% is about $23.52. But long story short, of all the money Microsoft earns, about $23 is attributable to the shares that we own.
So essentially, whenever Microsoft earns more, if I have a piece of their stock, then I earn more.
Exactly. So that's how our earnings will grow. We could buy more Microsoft and we'll have more shares earning us more money, or Microsoft will grow the amount of money they earn and we'll have more earnings per share. And again, we'll be earning more money, and they can buy back their shares so that there's fewer shares outstanding, so that our shares own a bigger percentage of the company. But long story short, across all our portfolio, we have a bunch of companies like this that are earning us money. We even have a few that are losing money. And we're doing this calculation for all these companies to say, hey, across all of our portfolio, the amount of money that all these companies are earning that's attributable to the shares we own right now is about $77. And the breakdown is $23.50 is from Microsoft, $17 from Meta, about $12.80 from this company called Opera. But long story short, that's the math behind it all. Does that kind of make sense?
Yeah, so we can kind of look at ourselves almost like we're investing on Shark Tank.
Yeah.
Even though we're not a early stage investor, as these companies earn more, we earn more. So the strategy is great, but does this mean you don't care about if the stock goes up and down?
So what's interesting with this type of strategy, you will actually want the stock price to go down so that you can buy more, because like I said, if we own more Microsoft, then our earnings will go up. So hey, if Microsoft's stock price goes down 50%, we can buy more, our earnings will go up, as long as Microsoft's earnings don't decrease 50%, right? Like all this assumes that these companies continue to grow. But if there's some world where Microsoft isn't earning $100 billion, that's probably a zombie apocalypse, nuclear war kind of thing.
Yeah, and if it was a zombie apocalypse, you would have bigger worries
exactly.
than what your stock portfolio is doing.
Exactly.
But that point you made about buying stocks when the market is down relates directly to how we use margin to buy when our portfolio is down.
That's correct, and that's exactly what our next portfolio update episode is about. Subscribe so you don't miss it, and remember,
This is all just for stocks and giggles.